What if I told you that the most powerful Forex strategy doesn't need fancy indicators, complex algorithms, or endless hours of analysis? I'm Alfred Mugo, and today I'm pulling back the curtain on a method so simple, yet so effective, it works on every single pair. Your USD, GBP, JPY, you name it. But here's the crazy part. I'm not just here to teach you this strategy. I'm here to test something wild on this channel. This is Alfred Mugo. Although the voice you are hearing is AI, worry not. Before I step on camera to reveal my full system, I'm going to experiment with strategies live, right in front of you, to see what truly moves the needle in the markets. This is the first step in that journey, and it's all about keeping things naked, stripping trading down to its rawest, most primal form. Get ready to rethink everything you know about Forex, because the support and resistance strategy is about to change the game. Let's dive into the theory behind this deceptively simple approach and prepare you for what's coming next. Picture this: a trading world where you don't need a PhD in math or a screen full of blinking lights to make money, just a chart and your own two eyes. That's what this strategy offers, and it's why I'm so excited to share it with you. I've been trading for years, and I've seen how complicated systems can leave you dizzy and broke, chasing signals that never pan out. This experiment is my way of cutting through all that noise, proving that the simplest tools can be the most powerful. Whether you're a newbie just dipping your toes into Forex or a seasoned trader tired of overthinking, this approach will feel like a breath of fresh air. I'll be testing it live on pairs like USD JPY and all CAD, showing you real-time results so you can see it in action. It's not just talk. This is hands-on, raw, and real. By the end, you'll wonder why you ever bothered with anything more complicated. So buckle up, because we're about to strip trading down to its bare bones and build something extraordinary together. The power of naked charts. Why simplicity rules. Imagine a trading method that cuts through the noise. No lagging indicators, no cluttered screens, just you and the raw heartbeat of the market. That's the beauty of the support and resistance strategy, a naked chart approach that's as old as trading itself, yet still one of the most reliable ways to read any Forex pair. Think of your chart as a living thing, pulsing with every tick of price. It's telling you a story, and all you need to do is listen. Naked charts ditch the overload of tools like MACD or Bollinger Bands that lag behind and muddy the waters. Instead, you're focusing on what's happening right now, not what some indicator thinks happened 10 candles ago. This method has been around forever because it works. It's like the wheel or fire of trading, a basic invention that never goes out of style. It's universal too. Whether you're trading the fast-moving GBP USD or the steady EU or CHF, these levels show up everywhere. Why? Because they're built on how traders think and act, not on some fancy software trick. It's almost like having a superpower. You see what others miss because you're not distracted by the chaos. Beginners love it for its clarity, and pros swear by it for its precision. Once you try it, you'll feel like you've been overcomplicating trading your whole life. The market's memory, where price tells its story. This strategy is all about identifying key price levels where the market has a memory, levels where buyers and sellers have clashed before, leaving invisible scars on the chart. These aren't random lines. They're battlegrounds where price has either held its ground or surrendered to a new direction. Imagine the chart as a battlefield, littered with the ghosts of past trades. Every time price hits one of these levels, it's like the market remembers the fight and gears up for round two. These scars form when buyers say, "No more selling," or sellers shout, "This rally stops here." The more times price revisits and respects these spots, the deeper the memory gets, like a groove worn into a dirt road by countless footsteps. It's not magic, it's psychology. Traders see these levels and react, piling in orders that make history repeat itself. For example, if EU or USD bounced off 1.2 thousand 3 times in the last month, that level's got some serious baggage. Spotting these zones is like being a detective, piecing together clues from the chart's past to predict its future. It's simple, but it's profound. Once you start seeing these battlegrounds, you'll never look at a chart the same way again. Support and resistance, the market's invisible walls. At the core of this strategy are two concepts: support and resistance. Support is like a floor beneath the price, a level where buyers have historically stepped in with enough force to stop the price from falling further. Think of it as a safety net woven from past swing lows, where the market has bounced upward time and time again. Resistance, on the other hand, is the ceiling, a level where sellers have consistently pushed back, halting the price's climb. These swing highs mark zones where the market has said, "not so fast," forcing price to retreat. Picture support as a trampoline under the price. When it drops, it hits this springy floor and bounces back up as buyers rush in to catch it. Resistance is like a concrete ceiling. Price slams into it, and sellers hammer it back down, refusing to let it break through. These aren't just lines on a chart. They're where the tug-of-war between bulls and bears gets real. For instance, if GBP/JPY keeps stalling at 150 style, that's a resistance wall built from seller strength. The same goes for support. Say USD CAD holds at 1.2500 multiple times. It's a floor trader's trust. These levels are invisible to the untrained eye, but once you see them, they're as clear as day. They're emotional hotspots where fear and greed collide, shaping the market's path. What's wild is how consistent this is across every pair. Human nature doesn't change, and neither do these walls. Learning to spot them is like getting a map to the market's soul, drawing the lines, mapping the market's DNA. By drawing horizontal lines at these levels, you're mapping out the market's natural boundaries, creating a blueprint of where price is likely to pause, reverse, or even break through with explosive momentum. It's a strategy that thrives on simplicity, but don't let that fool you. These levels hold the key to understanding the market's next move. Think of it like sketching the outline of a treasure map. Each line you draw marks an X where the market's secrets are buried. You're not guessing. You're tracing the footprints price has left behind, connecting the dots of past highs and lows. It's so simple you could do it with a pencil and paper, yet it reveals the market's DNA, the patterns that drive every move. For example, if EUSD keeps turning at 0.750, that line isn't random. It's a hotspot traders can't ignore. Drawing these lines is like turning on a light in a dark room. Suddenly, you see the walls and doorways of price action. It's not about flooding your chart with clutter, just a few clean lines that cut through the chaos. The beauty is in how little you need. No fancy tools, no tech overload, just observation and a steady hand. This map becomes your guide, showing you where to watch and wait for the market to tip its hand. Two ways to play: bounces and breakouts. The support and resistance strategy gives you two powerful ways to engage with the market: trading the bounce or trading the breakout. This is like having two plays in your trading playbook, each one ready to tackle a different market mood. Bounces are for when the market respects its old habits, sticking to the levels like a dog on a leash. Breakouts are for when it goes rogue, busting through those levels like a bull through a gate. It's flexible, letting you switch gears depending on what the chart's telling you. Maybe you're the cautious type who loves a safe bounce trade, or maybe you're the adrenaline junkie chasing breakout fireworks. Either way, this strategy's got you covered. It's like being a boxer with a jab and a hook. You can play defense or go for the knockout. On EURUSD, you might buy a bounce off 1.180 one day and ride a breakout above 1.2000 the next. This dual approach keeps you in the game no matter how wild the market gets, turning every level into an opportunity. Bounce trades, playing defense at key levels. When price approaches a well-defined support level, it's like watching a ball hit a trampoline. You can anticipate a bounce upward, a moment where buyers swarm in to defend that level. That's your cue to consider a buy, betting on history repeating itself. Conversely, when price nears a resistance level, it's like hitting a glass ceiling. Sellers often step in, pushing price back down, and that's where you might look to sell. This is the safe play. Like a goalie guarding the net, you're betting on the market sticking to its old tricks. When USD/JPY drops to a support at 110 and starts to climb, it's like the buyers are shouting, "Not today." That's your buy signal. Up at resistance, say 112.0, you'll see price stall as sellers pile in, giving you a clean shot to sell. It's all about timing, waiting for price to touch the level and show signs of rejection, like a pin bar or a quick reversal. These trades are low stress, because they lean on the market's memory, not wild guesses. Picture yourself fishing at a spot where the fish always bite. You just drop your line and wait. It's not about chasing price. It's about letting it come to you, making your move when the odds are stacked in your favor. For anyone who hates big risks, this is your bread and butter. Breakout trades when the market rewrites the rules. But what happens when the market decides to rewrite the rules? If price smashes through resistance and holds above it, it's a signal that a new uptrend might be born, a breakout that could lead to massive gains. The same goes for a break below support, hinting at a potential downtrend. This dual approach lets you adapt to the market's mood, whether it's playing defense at key levels or riding the wave of a breakout. This is the high-octane side of the strategy, like jumping on a rocket as it blasts off. When GBP/USD punches through 1.4 thousand and keeps climbing, it's like the market saying, new rules, big moves. That's your chance to buy and ride the trend. Down below, if it crashes through 138 support, you're looking at a sell-off waiting to happen. These trades are thrilling because they catch the market at its wildest, at turning a quiet chart into a gold mine. But here's the catch. You've got to be sure it's real. Wait for price to settle above or below the level, not just poke through. It's like surfing. You don't paddle for every ripple. You wait for the big wave. When it works, the profits can be huge, turning a small move into a game changer. This is for traders who love the rush and aren't afraid to bet on the market breaking free. Why this strategy is a beginner's dream. What makes this strategy so incredible for beginners is its purity. It's all about price action, untainted by lagging indicators or overcomplicated tools. If you're new to Forex, this is like learning to ride a bike with no training wheels. It's scary at first, but once you get it, you're free. There's no jargon to decode or software to buy, just a chart and some lines. It teaches you the heart of trading, how price moves, not how some indicator guesses it might move. Beginners often drown in tools they don't understand, but this cuts through that mess like a hot knife through butter. You'll learn to trust your eyes, spotting levels like 1.300 on EUR/USD where price flips without needing a manual. It's visual, it's hands-on, and it builds confidence fast. Plus, it's forgiving. You don't need perfect precision to start. Just draw a line and watch what happens. For anyone overwhelmed by Forex, this is your lifeline, turning chaos into something you can actually grasp. Clarity over chaos, the naked chart advantage. When you trade with a naked chart, you're not distracted by a dozen moving averages or RSI signals. You're focused on what the market is actually doing, right here, right now. Support and resistance levels are visually intuitive. You can see them with your own eyes, clear as day, on any chart, any pair, any time frame. It's like clearing the fog from a windshield. Suddenly, everything's sharp and obvious. No more squinting at crisscrossing lines wondering what they mean. You just see price hit 0.70 on all USD and bounce. Plain and simple. This clarity cuts decision time in half. You're not paralyzed by analysis. You're reacting to what's real. It works on a 5-minute chart for quick scalps or a daily chart for big swings. No adjustments needed. Imagine trading with noise-canceling headphones. All the chatter fades, and you hear the market's pulse loud and clear. It's a relief, especially if you've ever felt lost in indicator soup. This focus is why pros love it too. They know the chart itself holds the truth, not some lagging signal. Once you taste this clarity, you'll never want to clutter your screen again. The catch: it's not always perfect. Now let's keep it real. This strategy isn't a crystal ball. The market's a beast, and it doesn't care about your perfect lines. It'll surprise you, trick you, and sometimes leave you hanging. Price might blow through a support at 1.1 thousand on USD CHF like it's nothing, even if it held strong for weeks. Other times, it'll flirt with a breakout only to fake you out in reverse. That's trading. Nothing's 100%. And this strategy's no exception. It's not a magic wand you wave for instant riches. It's a tool that needs your brain and patience to shine. Losses will happen, and that's okay. They're lessons, not failures. The trick is not to get cocky or sloppy. Stick to the plan even when it stumbles. For every trader who nails it, there's one who quits too soon. Don't be that guy. This honesty is what makes it real. It's powerful, but it's not foolproof, and that's why it's worth mastering. False breakouts, the market's dirty trick. The market doesn't always play nice with support and resistance levels. Sometimes, price will break through a level you thought was rock solid, leaving you scratching your head. Other times, you'll see false breakouts. Price might poke through a level, teasing you into a trade, only to snap back and leave you in the red. False breakouts are like the market's prank call. It rings, you answer, and no one's there. Say EURJPY blasts past 130, you buy, and bam, it dives back below, leaving you with a loss and a bruised ego. It's sneaky because it preys on your excitement, tempting you to jump in too fast. These traps happen when big players push price just far enough to snag early birds before pulling the rug. The fix? Wait it out. Let price close above the level, like a full candle, before you bite. It's like checking the water before diving in. Better safe than soaked. They're annoying, sure, but they teach you patience, turning a dirty trick into a chance to get sharper. Every trader's been burned by one. The pros just learn to outsmart it. The art of Confluence, stacking the odds in your favor. That's why this strategy demands patience and observation. You'll need to look for confluence, where multiple levels from different time frames align, creating a stronger zone of interest. Confluence is like finding the perfect storm of signals. It's when the market's shouting, "Pay attention here." Maybe a daily support at 1.35 through on GBP/USD lines up with a 50% Fibonacci level and a round number. That's a triple threat you can't ignore. It's not just one clue. It's a pile of evidence stacking the deck in your favor. Think of it like a choir. One voice is nice, but a harmony of voices is unstoppable. Checking higher time frames adds weight. A level that holds on the daily and hourly charts is a fortress compared to a flimsy 5-minute line. This isn't about cluttering things up. It's still simple, just smarter. Patience is key. Don't force trades where confluence isn't clear. It's like waiting for all the stars to align before making your wish. When they do, your odds of winning skyrocket. Timeframes matter. The hierarchy of levels. Timeframes matter too. A support level on a daily chart carries more weight than one on a 15-minute chart. And subjectivity can creep in. Different traders might see these levels slightly differently, so it's on you to refine your eye for what's significant. Think of timeframes like a ladder. The higher you climb, the bigger the view. A daily level at 0.9 Zelzo on USD CAD has months of trader battles behind it, making it a brick wall compared to a 15-minute level that's just a speed bump. It's a hierarchy. Daily trumps hourly, hourly trumps 5-minute. But here's the twist. Your buddy might draw support at 0.899 while you see it at 0.900, and that's normal. Trading's part art, part science, and your eye gets sharper with practice. Start with the big picture, daily or 4-hour charts, to spot the heavy hitters, then zoom in for precision. It's like building a house. Lay the foundation first, then tweak the details. Over time, you'll spot the levels that scream importance, turning subjectivity into your personal edge. How to approach it. The mindset of simplicity. To make this strategy work, you've got to embrace a mindset of simplicity and discipline. This isn't about showing off with fancy gadgets. It's about nailing the basics like a chef perfecting a simple recipe. Simplicity keeps you sane when the market's flipping out. It's your anchor in the storm. Discipline is the muscle. Without it, even the best strategy flops. You'll be tempted to overthink or chase every wiggle month, but resist that urge. It's like gardening. Plant the seed, water it, and wait. Don't dig it up every day to check. Trust the levels, stick to your rules, and let the market come to you. This mindset spills over into life too. Focus on what matters, cut the fluff, and stay steady. It's not sexy, but it's how winners are made, one calm, clear trade at a time. Step 1. Choose your battlefield time frame. Start by choosing a time frame. Higher ones like the hourly or daily charts often give you more reliable levels, filtering out the noise of smaller fluctuations. This is where you pick your fight. Your battlefield sets the tone for every move. Hourly or daily charts are like the eagle's view, soaring above the chaos of 1-minute ticks. They show you the real levels, the ones traders worldwide are watching, not fleeting blips. Say you pick the daily chart for EURUSD. Suddenly, 1.2 thousand stands out like a neon sign, tested over months. Lower time frames are a jungle of noise, full of fake signals that'll trip you up. Higher ones cut through that, giving you solid ground to stand on. It's like choosing a quiet room to think instead of a crowded street. Nail this step, and you're trading with the market's rhythm, not against it. Step 2. Hunt the swing highs and lows. Look back at the chart's history and identify the obvious swing highs and lows, marking them with horizontal lines. This is your treasure hunt. Scroll back and find the peaks and valleys where price flipped the script. A swing high on USD JPY at 112 is where the rally died. A swing low at 110 is where it sprang back. These are the market's turning points, like chapter breaks in a book. The more times price hits and respects them, the stronger they get. Think of it as a wall reinforced with every test. Grab your chart, zoom out, and mark them with lines. It's like pinning flags on a map. Don't overdo it, just the obvious ones that jump out. It's simple detective work, and soon you'll see these spots glow like gold. This step builds your playbook, showing you where the action's likely to heat up next. Step 3. Wait for the market to come to you. Then wait. Patience is your greatest ally here. Let the price come to your level and watch how it reacts. This is where you play the waiting game, like a hunter in a blind, silent, and ready. Chasing price is a rookie mistake. Let it stroll up to your level, say 12500 on USD CAD, and show its cards. Does it bounce, stall, or blast through? That's your signal, not some gut hunch. Watch for clues, a quick dip and rise lock, a doji candle, anything that says, this level matters. It's tempting to jump early, but patience pays off with cleaner trades. Think of it like fishing. You don't yank the line at every nibble, you wait for the tug. This step turns you from a gambler into a strategist, letting the market prove itself before you risk a dime. Cry. Confirmation is king, don't chase ghosts. For bounces, you're looking for price to respect the level. For breakouts, you want confirmation, a strong close beyond the level to signal the market's intent. Confirmation is your bouncer. It keeps the riffraff out of your trades. For a bounce at 0.68 on odd USD, wait for a clear rejection, like a hammer candle, before buying. For a breakout above 0.7 don't bite until the candle closes strong, showing real muscle. This weeds out fake moves that'll burn you. It's like waiting for a friend to knock twice before opening the door. Proof they're legit. No confirmation, no trade. That's the rule. It takes guts to hold off when price teases you, but it's how you dodge traps. This step locks in your edge, turning hope into hard evidence. Risk management, your survival kit. Always define your risk with a stop loss just beyond the level, and set a take profit that aligns with your risk to reward goals. This isn't about overcomplicating things with extra tools. It's about trusting the chart and letting the market speak for itself. Risk management is your lifeboat. Skip it, and you're sunk. Set a stop just past your level, say 1.1950 below 1.2000 support on Euro USD, so a breakout doesn't gut you. Your take profit might hit 1.20, doubling your risk for a sweet reward. It's simple math. Lose small, win big. This keeps you in the game even when trades go south. Picture it like a seatbelt. Basic, but it saves lives. You don't need fancy tricks. The levels tell you where to cap your downside and aim your upside. It's the glue that holds this strategy together, turning wild swings into controlled wins. Final thought, the experiment continues. The support and resistance strategy is more than just a method. It's a way of seeing the market in its purest form, a strategy that works on every pair because it's rooted in the universal language of price. As part of my crazy experiment on this channel, I'll be testing this approach live, showing you how these levels play out in real time across different pairs. This is just the beginning. I'm preparing you for what's to come, building the foundation for when I step on camera and reveal even more. For now, start looking at your charts with fresh eyes. See where price has paused, where it's reversed, where it's broken free. Practice spotting these levels because they're the key to unlocking the market's secrets. Stay tuned for the next phase of this journey. We're keeping it simple, but the results might just blow your mind. This isn't just a strategy, it's a lens to see the market's soul, and I'm pumped to prove it works live. Watch me trade GBP JPY or USD CHF, marking levels and calling shots as they happen. No edits, no fluff. It's raw, real, and a little nuts, but that's how we'll uncover the truth. Grab your charts now. Find that 1/4 order resistance on GBP USD or a 0.95 of support on USD CHF and start watching. These levels are like the market's fingerprints, unique yet universal, showing up everywhere from Tokyo to New York. This foundation is your launch pad. What I show next will take it to another level. Keep your eyes peeled because this experiment's about to get wild, and you're along for the ride.